So this is stock chapter 14. There's your learning objectives. And I know a lot of you probably remember a little bit something about stocks from Finance 3000. Um, this is more about the qualitative part, kind of what stocks are, investing in stocks, not so much the valuation that we did in 3000. So what are the most important features of a stock? So, when you look at trying to pick stocks, first of all, it's really hard, basically impossible, to try to beat the stock market. What I mean by the market, usually when someone says, can you beat the market, referring to like the S&P, Standard & Poor's 500. These are 500 stocks of like the largest companies in the United States. And when people buy stocks, they usually try to say, can I beat the market? And it's almost impossible. There are some people that do it continuously, but it's very, very rare. So in my book, if you can't beat them, join them, which basically means just buy the S&P 500. And you can do that by investing in certain what we call index funds. For example, you can buy, it's a symbol SPY, called a spider, stands for the S&P 500. You can just buy that, and all your money is invested in those 500 stocks, and you're done. So we don't even have to really talk about this chapter. We're good. Forget it. No, I'm just kidding. It's no fun, really. I won't say it's no fun, but it's not much. It's great when you're making money, but I don't do my investments that way. I put a lot of my money into index funds like this, but it's fun to try to beat the market. And it really shouldn't be that way, because this is for me, my retirement. But I teach finance, so I really, I got into this field because I like doing this stuff. So I like trying to figure out, how much do I think sales are going to increase? How much do I think net income and earnings per share are going to go up? And try to find those companies. So when we've got this COVID situation, the stock market has just been crazy. I've had some big time losers at the beginning of COVID. I did some things that went against what I would normally tell anybody else to do. And then I've kind of took some I'll call them gambles, I wouldn't really say gambles per se, but I got back into the market and bought a lot of stocks that have done really well since we've been recovering since COVID. So I had some really kind of big downs, and I had some big ups. And that's been fun. Now, when I say fun, I lost kind of some sleep over some of it, and that's not a good thing. So anyway, enough about me. So most of you know this, why do corporations issue, meaning sell stock? And its bottom line is to raise money. It's as simple as that. It's a form of equity. So when we talk about equities, I've said this before last chapter, equities are stock. Okay, so equities are stock, debt are bonds. Companies sell stock, they don't have to repay. Okay, and the company does not have to buy the stock back from the shareholders. Okay? And if you're a shareholder, you can sell the stock anytime. Dividends are not mandatory. Companies do not have to pay dividends, but they're paid out of profits. Board of directors approves that. Most corporations distribute 30 to 70% of their earnings to shareholders. That sounds a little bit high to me, but I'll take their word for it, the author's word for it. There's a lot of companies, especially high-tech companies, that don't pay any dividends at all, because they're just taking their profits and reinvesting it back into their company. It's not that it's a bad thing, it's just different ways. Remember, there's two ways we make money in the stock market: dividends and capital gains for the stocks going up and down. Okay, so if you own stock, you get to vote. Okay, so that's what you get in return, but that's not really what you want in return. I've owned numerous stocks and I have the right to vote, but I a lot of times don't even vote. My vote is, imagine I have a few shares, 100 shares or whatever of Apple. The amount of shares I have in Apple compared to everybody, it's like a you'd have to look under a microscope to see it. It's just so small. So I'm not going to make any impact. I know that's probably not the best way to look at it. But anyway, we elect the shareholders, elect the board of directors, and if we don't like what's happening in the company, then that's how things get changed. The board of directors, maybe we put somebody else in there. So why do investors purchase stock? To make money. Simple as that. And as I said, you make money through dividends and through the appreciation or the stock price going up. It's what we call that a capital gain. Okay, capital gain. One way and I'm not, the key word here is possible increased value from a stock split. Okay, this happens every once in a while. A lot of people get really excited because, hey, my stock split. It really doesn't mean anything. A stock split is the same as I've got a $10 bill and I exchange it with somebody for two $5 bills. Did I make any more money? No. But I now have two pieces of paper as opposed to one piece of paper. Okay? Instead of one $10 bill, I have two $5 bills. So it doesn't change anything financially for the company. But here's why a lot of people talk about stock splits. So the reason why stock splits are happening is a lot of times the stock price will be going up and it'll get to a pretty high price and the company wants to make their stock available to those of us that don't have a lot of money, and they say, okay, we'll reduce the price from 10 down to 5, and now more people can afford to buy the stock. And therefore, creating more demand for the stock, and therefore it will sometimes go up. The other thing to think about is when you have a stock split, that means that things have been going very well for the company and the stock price has been rising. So it means that the stock split probably isn't really causing the price to rise. It's probably the fact the company is still doing well. So here's an example. Apple had a 4-for-1 stock split. That means that for every one share that you own, so you get 4 shares for every one that you own. So the price was at 400. Okay, that's the price. And then on August 28th, the price got cut, divided by 4, went down to $100. Okay? So that wasn't the exact price, it's a little over $400. But basically it is cut it by a fourth. And then everybody got 3 more shares for each one that they had. So they had a total of 4. If you had 100 shares, you now have 400 shares. Now, if you notice what happened, here's when the stock split happened. The price did go up a little bit there. But then look at what happened ever since then. And today the stock price is right around there. Okay, this is November. And the stock price had been going up quite a bit. Okay, but then after the stock split, it didn't do much. So that's just one example. My point is, it doesn't always mean that you're going to make a lot of money if a stock split. So there was a little bit of hype right there. Then after that, kind of died down. Okay? So you have common stock and preferred stock. Preferred means the shareholders of those companies, or that stock I should say, because companies have both preferred and common, not always. Common is the most common. They get their dividends before common shareholders get any. And if the company were to go out of business, they get their money before. And a lot of people kind of consider a preferred stock like halfway between a common stock and a bond, because common shares often don't pay dividends and bonds pay a lot of return, meaning interest. Okay, so preferred is kind of like in between that, because they pay high dividends. Okay? And preferred stock dividends are less secure than bonds. So when you kind of think of a continuum, we'll call it risk. Okay? You have stocks here, common stocks, you have bonds here, and then you have preferred stocks here kind of in the middle. Okay? So they're considered a little bit safer than common stock. So when you buy stocks, they can be classified, or they are classified in categories. So I just want you to think about kind of what these terms mean. So just look at them for a second and see. So give you just a quiz in your mind. You know, what is blue chip? What is cyclical? Just go through all of these as I'm talking and see if you can describe what those are. If you're going to be a financial planner, you really need to know what those are because you're going to be talking to your clients about these. If you're not a financial planner and you just get hired at a job and they'll say, okay, here's a mutual fund and it's a mid-cap mutual fund. You're going to be like, well, what the heck is that? Okay, so it's good for you to know we do a lot of terminology in this class. This is one of probably the most important when it comes to investing in the stock market. So as I keep talking here, just try to think about what all of these mean. You can put me on pause. Okay, so here we go. Blue chip. In poker, blue chips are considered the highest value. So blue chip stocks are stocks that are often in the Dow Jones Industrial Average. And there's only 30 stocks in the Dow Jones Industrial Average. These are big name companies, AT&T, Disney, IBM, I don't know all the names of them, doesn't matter, but these are like very well-known companies that have been around for many, many, many years, and these are what we call blue chip stocks. Okay? Cyclical means that you kind of in various economic cycles, these stocks would do very well. So maybe if the economy is kind of really turning down, airline stocks won't do as well because people are not traveling. Defensive stocks. These are not stocks that are military stocks. They're not like defense in terms of making tanks and so on. These are companies, probably Walmart could be considered like a defensive stock, AEP, utilities. These are stocks that say, okay, regardless of like what happens with the economy, people still need their products or services. So they're not going to be really impacted that much. They're not going to really go up a lot if the economy does well, not going to go down a lot if it doesn't do well. Growth, these are going to be companies that really aren't paying dividends. They're growing faster than the stock market on average. So these are more like high tech, biotech, things like that. Income, these are ones that pay a lot of dividends. So these are going to be more like utility companies, older companies that have been around that are not growing so fast, but they're paying a lot more in dividends, more maybe real estate kind of companies. So this word cap is short for capitalization. And all it means is size. It's just size. So market capitalization just means like how many shares you have and also the price of the stock, so how large the company is. So large cap simply means large companies, medium size, small, micro, very small. And all of these have different thresholds. I don't know the thresholds. You don't need to know the thresholds. You know, something like these are like greater than $10 billion in assets or something like that, or stock market value. Penny stocks, I've seen two different kind of definitions, and the easiest one to remember is less than $1. So you can buy it for 89 cents or 3 cents. It's what we call penny stocks. And these tend to be riskier. Okay? These are going to be riskier if they're really that inexpensive, right? So those are different classifications. So how can you find out about stocks? All kinds of online material available. Our library has a lot of digital resources and some printed where you can get resources such as Morningstar. I think Morningstar, I know Value Line, some Standard & Poor's. If you go online, you can get those for free being a student. Normally you would have to pay. Seeking Alpha is somewhat free. I like it. I like their app, but they've just recently gone to you only get so many free articles and then you have to pay. But it's still a good app to get. So anyway, all of these are going to give you kind of an analysis of a company. Now I'm going to try to pull up a value line here for you. So here's a value line. you just Google Value Line, it'll come up. Now they don't give this much information for every company, but here's Apple. You see here it shows the last price was 117. It's on March 8th. They'll give you an estimated price. In this case, 3 to 5 years. This is what they do for companies. They'll say it's $130 to $155. They say that's the highest financial strength that you're going to get. It's very safe. So on a scale of 1 to 5, 1's really good. And they give you a lot of financial information here. 3 to 5 year projections on cash flow per share. That's the price. Earnings per share, and so on. Down here you have kind of their past data, certain financial ratios and so on, and then where they estimate it to be in 2021, okay, in terms of earnings per share and so on. Here's what they've done historically. Well, I'm sorry, there's quarterly, there's annual, there's what they're expecting. So all kinds of information regarding, compared to its peers. Insider transactions. So insider transactions are like members of the board, if they bought or sold. Technical ranking refers to technical analysis. We'll talk about that later. And so on. Okay? So you can see there's all kinds of information there, and they have even more than that available. So that's Value Line, and you'll see similar stuff like that with Standard & Poor's and Morningstar. Okay? So once again, some of the things that the really key thing that investors look at are really earnings per share, EPS, earnings per share. And so one of the most common ratios investors look at are the price to earnings. So PE ratio, how much you're paying versus how much you're getting. Now, this is a really hard ratio to look at. So for example, Tesla's stock, oh gosh, I remember last year we were talking about it in class, it was like $200. And recently it went up to 800 plus. And they weren't even making any money. So it had a negative PE ratio. So you think, why would I invest in a company that has it's not making money? It's all about future earnings. So if you remember from 3000, the value of a firm is the present value of all future cash flows. Right now, a company might be losing money. But in the future, if you're looking at earnings, right now they might be losing money, but eventually, this is time and this is earnings, eventually they might be making money. So when you're trying to figure out the price, you're going to take the present value of all of these back to today, including the negative ones, but if they're going to do really well in the future, you're willing to pay for it. All right, so some other ratios. Dividend payout ratio simply says, okay, how much of a company's earnings are being paid out in dividends? And not that that's a big deal, but for some people are really looking for income. And then the dividend yield, that is a big deal. So I invest my mother's money, and she's elderly, and she needs to have income. And so what I look for are stocks primarily that have a high dividend yield. And so, if we can make 4%, then she has to try to live off that 4%. So dividend yield is very important when you're looking at trying to bring in some income. For most of you, you're going to be looking at kind of growth stocks, not really income stocks. So the way we calculate our total return, as I've said earlier, you can make it through dividends or capital gain, which means like the price goes up. Okay? And there's the calculation for what kind of return you get. The beta. Beta really addresses how volatile a stock is. So if we're looking at a stock that's going all over like this, okay, as opposed to one that's like this one has more risk because you don't know what's going to happen. It's really going high, really going low. So a stock with a higher beta tends to have more risk because we're comparing the volatility. And the volatility of the S&P index is 1. So the S&P 500, they say, okay, the stock market, that's kind of our benchmark. We're going to say the beta of it is 1. So if your stock has a beta of 2, that means your stock price is going twice as much up, twice as much down as what the stock market does. So it has a lot more volatility. Okay? If it has a beta of 0.5, then it's moving half as much. So a lower beta typically means that it's kind of like a correlation coefficient, but kind of how correlated it is to the market. But it's really about how volatile it is. Book value per share, you might remember, is from 3000. This is basically what our equity is in the stock versus compared to the shares outstanding. So this would be book value, and then when you buy a stock, you're paying the market price. Okay, so this is the book price, what it is on the books. When you open up your books, what our balance sheet say? Assets minus liabilities. There's our equity. How's that compared to what we're paying in the market? And it's different because our assets are listed like at the price we bought them, but they could increase in value. The market to book ratio is just a comparison of those two numbers I just talked about. So there's the book value per share. So let's say it's whatever. Let me go here. The market value might be something like 50, and the book value might be something like 5. So this is equal to 10. So the lower this is, the closer the market is to the book, kind of what people would consider the better value. And sometimes, so for example, some banks, a lot of banks, trade below book value. I work at a bank. Our bank is selling for less than book value at the moment, okay? Which means that if we were to sell our bank, we have all these deposits, and we would get a lot more. We're like, I don't know, 80%. We're selling maybe like 80% of book value, which is what a lot of banks do. If the bank gets sold, then you're going to get at least book value, and banks usually sell for over book value. So anyway, there are some companies that sell for really close to that, okay? And that's basically explaining what I just said. Right, so there's a few different ways we can look at how we value stocks. We talked about this in 3000. Fundamental analysis, where we look at what we call the fundamentals. Is the company making money? What's the overall financial strength? Is the industry good? Are they making new products? Are they dying? What's going on with the economy? These are what we call kind of the fundamentals. The other way of looking at things is at the technical analysis. And if you remember, I don't know if I'm going to be able to bring this up, down here at the bottom of the Apple thing, it said, here's the technical rank. Sorry. Here's the technical rank. And what it's looking at, it has all of these things that compare how the stock price is moving compared to really just itself. So technical analysis, they're making the assumption that the stock market's value is determined by forces of supply and demand in the stock market as a whole. And it's not based on expected earnings, like fundamental was. It's really just looking at trends, okay? Past market trends. And you have all of these charts, and they look at trends. So there's your blanks. Trends, trends, trends. What's going on in the price? Don't care who's running it, what products they have. What are the trends? So here's, for example, a stock, and they've drawn a line here and said, look, whenever it kind of comes down to this line, that's a good buying point. Let's buy, let's buy, let's buy. And you could also draw, I'm surprised they don't have a line here. This would be like what they call a support and resistance line. And if it ever kind of hit this line, it'd be time to sell. So it looks like, maybe it'd be time to sell this company. And if it ever came down to this line, it'd be a good buying time. Now, this happens to be a really nice defined chart, and you can say, okay, yeah, a lot of stocks have done this, kind of like during COVID. This is a while ago, it's like 2014. But anyway, that's to show you what we call just one type of technical analysis. So I don't like this first statement, based on some stock price are purely random. Um, so there's what they call the random walk theory, which kind of means that you really have a hard time predicting exactly what the next particular movement's going to be. The efficient market hypothesis says there's kind of like three different forms of the efficient market hypothesis. One is saying that every single bit of information is already priced into the stock market, so there's no way that anybody can really get an advantage and be able to outperform the market in general. Then, so they kind of have three grades. The weak form on the other end says there's still a lot of information that can be uncovered and therefore people can beat the market. Well, research has shown it's probably kind of right in the middle, that there's maybe some information that you could glean that people maybe don't have that you can figure out and be able to beat the market. But regardless, this is pretty much saying it's impossible for an investor to really outperform the market unless they just take on riskier investments. Okay? So it's kind of saying that the market is really efficient market. Market is efficient, meaning that all information is already factored in to the market. So someone asked me, well, if the government passes the 1.9 trillion bill, will that impact stocks? Well, you got to remember that everybody kind of already expected the bill to pass. Now, there was a chance that it wouldn't. So part of the market went up today and part of it didn't go up because, if people expect things to happen, it's probably already factored in. Right? All right, so in terms of how stocks are sold, we have the primary market, which is when stocks are sold for the first time, primary time, okay? And so what happens is a company that's already doing business and they decide they want to raise more money, they would hire like an investment bank. These are firms that help companies sell stock. And when they sell stock for the first time, it's called an IPO, I for initial public offering, the first time they offer it. And we talked about this in 3000. And then a secondary market means that, okay, once we've sold it to the public, that was the first time, primary market, then it's in the secondary market, which is like the New York Stock Exchange. So that's for existing financial securities. They're just selling kind of amongst themselves. Then we have what's called, so that's, like the New York Stock Exchange. Another secondary market is what we refer to as the NASDAQ. So the New York Stock Exchange is a physical place you can go visit on Wall Street in New York City. When I say visit, I guess you can't really visit there anymore. Certain people can get in, but since 9/11, they don't really allow visitors. NASDAQ is just a computerized trading system. Most everything's done by the computer anyway, so you can't really go visit it per se. Some of you might want to become a stockbroker someday, so that's what we typically call an account executive. And if you're going to be a stockbroker, you really need to get that SIE. If you want to be a financial planner, work on getting your SIE right now before you graduate, so you can get that internship, so you can get that job. You say, I already have it. Just had a girl who got it a few months ago. And basically studied on her own. I helped her some, but she studied on her own and passed it, took it online. It's only like an hour and a half exam, hour and 45 minutes. So anyway, if you're going into the financial industry and you're going to need a certification someday, the first thing you have to get is the SIE exam. Take it. Just says generally account executives are not liable for client losses that result from the recommendation. Just to share it. So I used to be a stockbroker many years ago, and one of the reasons that I got out was, one, I really love teaching. I prefer teaching over being a stockbroker, but I really like the industry. And I remember, I had clients and I would recommend certain stocks, and a lot of times they did just fine, but sometimes the stocks went down. And I felt really, really bad about it. Now, no client, as far as I know, ever got mad at me because they realized the risk with investing in the stock market. All stocks go up and down, but I just felt really bad. So you have to realize your temperament, how how can you deal with situations like that? Okay. So anyway, so there's different types of brokerage houses. So if you want to be a stockbroker, you're going to, for the most part, probably work for more of a full service firm. And so in the past, these used to be the lines used to be pretty delineated. Now they're kind of blurring together. Ameritrade and Charles Schwab have merged, and they have kind of like discount online, and they have some services now that you can pay a little bit extra for. So, but typically discount is like you can't really even talk to anybody. Like probably Robinhood, you get a trade for free, but you're not going to talk to somebody, and they're not going to help you with your financial planning. A full service firm, like say a Merrill Lynch or Edward Jones, you might have to pay a little bit more to trade, but you're going to be able to talk to your financial advisor, your stockbroker, ask them questions, they'll give you recommendations, and so on. So full service, just like anything, you pay a little bit more, you get a little bit more services. So similar to the FDIC, which is for banks, and in the securities industry, so if you have money with a broker and the broker ends up having issues, goes bankrupt or whatever, you are protected by the SIPC, Securities Investment Protection. It's kind of like an insurance. You're protected up to $500,000, and just in case something were to happen to that brokerage firm. And it's very, very rare that things like that happen today. So if you want to buy a stock, and a lot of you can easily open up an account with Robinhood. I'm not a real big fan of Robinhood. I talk about in my 2010 class how to do it, but ever since kind of this whole GameStop, maybe some of you read about that, what's been happening, not quite as happy about Robinhood. I would rather go with something like Ameritrade, and it costs hardly anything. I think Ameritrade even has free trading. I have an account there, but I don't remember. The point is, the thing I don't like about Robinhood is it almost makes investing game-like, and they send you kind of notifications, hey, this stock's doing this or that, and it's kind of like, hey, kind of encourages you to almost day trade, and that's how they make their money, is by you buying and selling. But anyway, if you want to buy a stock and you want to buy it like right now, you say, hey, I want to buy whatever, GameStop, I want to buy Citigroup, I want to buy Apple, and I want to buy it right now. You would place what we call a market order. So as soon as your order hits the stock exchange, you're going to buy it regardless of the price. If you say, Apple right now is at 115, and the most I want to pay is 105, you can put in a limit order. You say, look, that's my limit that I want to pay for this stock. So your order will be there, and if it ever comes down and hits 105, then you'll buy it. But it's also a chance that it never comes down and just keeps going up, then you've lost out. So pros and cons with that. The stop loss order means that you've already bought your stock. So let's say you bought it at 80. Okay, you bought it right here, and it goes up, and it's maybe $90 or whatever, and you want to sleep at night, and you don't want to like lose all your money, so you could put a stop loss at $70, which means that as long as the stock stays above $70, nothing happens. But if it comes down and hits 70, then you have an order to sell. So in essence, you are trying to stop your losses in this case, at $10. There's no guarantee it'll sell at 70. It just becomes a market order, and if the market's like really crashing, you may not get out until 65. But it's kind of like, okay, if I don't really ever want to watch the stock market, but I want to make sure that I'm really not going to lose any more than X amount of money, I can put in a stop loss order. The best way to invest, according to research, is to buy and hold. And that means probably buying like an index fund. We'll talk about funds later in another chapter. But a fund that invests, like I mentioned before, S&P 500. Put it in there, hold it, forget about it. That's it. Here's what happens. Stock market starts going up. You have excitement, thrill, euphoria. Great. You think you're the smartest person. Then it starts going down. Oh, I hate it. I'm afraid. Desperation, panic. So here's what happens. Stock market goes down. And what do a lot of people do? And I've been guilty of this. They sell. Okay? Just like here, they buy often. Hey, the stock market keeps going up, going up, going, and they buy. And then it starts going down. It goes down so far they sold. So this is kind of what happened in like 2008. 2008 stock market crashed. I lost like 40%. Fortunately, I held on. I didn't have any more money to buy anymore. I just held on. My wife said, I don't want to be in this market anymore. This is just crazy. I said, no. The worst time to sell is when everybody is selling. Prices are really low. Let's just hold on. Thankfully, she held on. Stock market came back really well over the next 10 years, whatever. Right? So keep that in mind. All of you have over 40 years to invest. You're going to see ups and downs. When it goes down, don't freak out. And those of you who are going to be financial planners, your boss, your company is going to tell you to tell your clients, best thing to do, remain calm. Do you have any more money to maybe be investing because prices are depressed? And over a long period of time, stock market has done well and it's kind of eventually always kind of trended upwards. So keep that in mind. Don't sell when you just totally freak out probably. Another good way to invest is what we call dollar cost averaging. So you put the same dollar amount in at regular intervals, every month, every year, whatever. And I'm not going to, I really would like you to go through this chart, but let me just real quickly explain. So the investment is the exact same every month. And notice at $10, you buy 10 shares. At $6, you buy 16 shares. So you buy more shares when the price is low, fewer shares when the price is high. So what happens is, if you were to just do a pure average on this, you'd be paying $8. If you said, okay, I'm just going to buy this one share every time, you would have paid on average $8. But in this case, you'd be buying it for like about $7.73. Okay? When you compared your 500 to your 64 shares. So you're lowering, now that's not in a real extreme case, you don't see a big difference there, but basically you're lowering your average cost per share because you buy more shares when the price is low. So that's a great thing about dollar cost averaging. You can also have like dividend reinvestment plans where you invest in a stock and they'll allow you to take the dividends that they would pay and buy more shares with that. Okay? So you set that up with the companies. Last thing I want to talk about, I've mentioned this before, kind of different ways to invest. Is day trading. New study shows just how unprofitable day trading is. Research found that 3% of traders make money. Just 3%. I had heard it was like 1 in 10, but this is even worse, with less than 1% making minimum wage. So here's another chart showing day traders. Only 7% remain after 5 years. So Robinhood has really impacted the increase of day trading because it's just so easy to do. Don't get caught up into it. Yeah, it can be like fun, just like going to Vegas is fun, but you typically end up losing money. So to me, day trading is very much like gambling. Most of the time you're going to lose money. Investing, most of the time you're going to make money. So you decide. Okay? In terms of, so we have short-term trading, that's day trading. Day trading simply means you're like buying and selling in the same day. Okay? Buying stock on margin means that, let's say you put $100,000 into, or whatever, $10,000 into your brokerage account. You can borrow money on that $10,000 that you've put in there from your brokerage. And you can then use that money to buy more stocks. But the interest rate can be pretty high. So there's like 8% you're paying just for that money. So you got to make sure you make at least the 8%. And then selling short, this is, okay, so I think Apple's too high right now, and I think it's going to go down in value. You can take advantage of that, meaning if you think it's going to go down, you can invest in a way that you make money by stock prices going down. So, we normally we like to buy low and sell high. Okay? That's how 90% of the trades work. But if you think something's going to go down in value, you can do it just the opposite. You can sell first, which you hope to sell it at a high point, and then you can buy it back at a low point. So you've done a buy and a sell, you've just done them in reverse order. What you do is you borrow somebody else's stock and say, hey, can I borrow your stock? Okay, I'll borrow it, I sell it, I buy it back later at a lower price, ideally, and I give it back to that person. Now that's really simplified, okay? But there's kind of a little chart of kind of how that works. Step one, borrows it. Step two, sells it. Step three, you buy it back at a lower price. Now, you might have to buy it back at a higher price, which means you lost money. It's very risky because stock prices can go up infinitely. They can go down to zero is all you can make. But anyway, so the bottom line is selling short basically means you're trying to profit off a stock going down in the value. Okay? So that is an overview of stocks and the stock market.